The classic elevator pitch. You really can, the best ideas, the best companies you can describe in 30 seconds. More companies die from indigestion and starvation. They try to do too many things, try to make too many things work, versus not having enough opportunity in the core thing that they're focusing on. The day that we make an investment, we don't expect to be out of that investment for sort of 5 to 8 years. Stay tuned on Cashing In. So Sigma's been around for 30 years, almost 30 years. Firm started in Silicon Valley, and we recently moved up to San Francisco after spending the first 29 plus years down in Silicon Valley. From the beginning, we've done early stage tech investing. We used to do some biotech, but today we're only tech, and we're really only software investors. And we take very active roles in the companies that we work with. We take board seats and are usually the first institutional money in, but sometimes first, sometimes second institutional money. But typically, one of the few investor board members in the companies we work with. Well, the venture business has gone through a big transformation in the last 15 years since the bursting of the dot-com bubble, and I think that it's continuing to go through a transformation. The emergence of angel investors in the last really 5-6 years as a major force in the sort of venture ecosystem really has helped transform the business. Plus, a lot of the institutional money that's going into venture has pulled back. In the bubble, the venture business as a whole was raising $100 billion a year, and now it's raising about $20 billion a year. So we primarily do enterprise technologies, B2B technologies. We do a couple of things in the consumer space, but for the most part, we invest in companies that are building software solutions for businesses, whether that's cloud solutions, software as a service, business applications, security, infrastructure, networking, database, those sorts of things. Typical first investment for us will be between $1.5 million and $4 or $5 million. We expect to put $8 to $10 million into a company over the time that we're involved. Our primary focus is on finding great teams. We have a bunch of sectors that we follow, sectors that we like a lot, but the most important thing is the quality of the team. We don't really invest in markets. We don't go and find the 10 companies that are doing the next, whatever thing and try to invest in the best one. We find great people, and those great people tend to change what they do over time, a lot of times. I think that the one most important thing is the entrepreneur needs to be able to articulate what they're doing concisely and in a compelling way. If an entrepreneur, I see this all the time, if an entrepreneur can't tell you in 30 seconds what they're doing, why it's important, and why anyone cares, they need to go back to the drawing board and figure it out. We have people come in that take 5 minutes to explain, I'm doing this and this and this and this and this, and at the end of 5 minutes you're kind of scratching your head and saying, well, what are they doing? It's the classic elevator pitch. You really can, the best ideas, the best companies you can describe in 30 seconds. We typically look at a couple hundred opportunities for every investment that we make. Unlike angel investing, where you make a lot of small investments, we make a few bigger investments, and then we work with those investments. We're a part of the team from the time we put money in until typically until the exit of the company, and we expect to be a part of the team until the company's sold or goes public. And as a result, we have a high hurdle before we make the investment. If you're only dropping small checks in a bunch of little things, you expect a bunch of those to blow up. The hurdle isn't that hard. You can spend 10 minutes with somebody and pull the trigger. For us, it takes a little bit longer, and we spend a little more time evaluating. Valuation at the stage that we invest in is more art than science, and it's more driven by the broader market. A typical Series A deal that has an interested set of investors, where more than one investor is interested, needs a certain amount of capital, and the investors need to own a certain amount at the end of the day. And you sort of back into a valuation through those things. You can't price too much below the market. You can't price too much above the market. In every company that we get involved with, we take a board seat. We're very active with them. We tap our networks of other successful CEOs, successful entrepreneurs, successful executives from other companies. We bring those other successful executives into the new investments to help them with whatever problems they're having. Every company that we invest in, the day that we invest, we see issues. Like the company has issues, but obviously the opportunities and the core assets of the company in our minds outweighed the challenges that we saw in front of them. So, our whole approach is to be completely open and direct about the issues we see, and try to work with the team to minimize those issues or solve those issues. Whether it's the marketing challenge, or the company doesn't yet know what sales model they're going to put in place, and is this an inside sales or outside sales, or is it all frictionless on the web, or what have you. So when we make the investment, we know what some of the challenges are in the company, and we're working from actually before day one, before the investment is made, we're working with those entrepreneurs to help solve those problems. One of the big changes in the venture business in the last 10, 15 years is the amount of time to exit. It used to be 3 to 5 years, and now it's more like 5 to 8 years. And that's pretty typical, 5 to 8 years. You ideally would like to have some investments that you exit sooner, but the day that we make an investment, we don't expect to be out of that investment for sort of 5 to 8 years. In the venture business, you're always shooting for greater than 10x return on your big winners. And typically on our big winners, we've generated more than 10x return. But I think one of the things that has really set our investments apart from a lot of other firms, a lot of firms are gunning for the 100x, 1000x, and we'd love to have those. But a 2x, a 3x is good for the entrepreneurs, good for us, good for everybody. And the firms that tend to shoot for the 1000x, if something looks like it's going to be a 2x, they tend to abandon those because their time is better spent. They believe, oh, that's not going to be a big win, let me go for this one. And we, again, as I said earlier, we typically work with a company from beginning all the way to the exit. And companies go through peaks and valleys along that way. The single most important thing for any entrepreneurial company is to focus. Figure out what you're doing and focus on that. Now, there's always what if that doesn't work, and when do I veer off of that and defocus and that sort of thing. And that is, you have to do that sometimes. But more companies die from indigestion and starvation. They try to do too many things, try to make too many things work, versus not having enough opportunity in the core thing that they're focusing on. So the biggest single piece of advice that I typically give to any entrepreneur is focus. And the earlier thing that I started with, this idea of being able to concisely and simply describe what you're doing, that kind of goes hand in hand with focus. The companies that take 10 minutes to describe what they're doing probably aren't all that well focused. The companies that can tell you in 15 or 20 seconds what they're doing, they know who they are, they know what they're doing. And those are the ones that have the biggest chance of being truly successful.